You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. Going to have a little bit of a shorter show this week because I have to hop out on a plane right after the show is done. But that doesn't mean we're not going to bring you your dose of volatility. We know a lot of you can't start your week without a good dose of volatility viewing, so we're going to make sure you get that. And joining me in this noble endeavor, starting off with the man beaming in from that volatility hotspot known as scenic and sunny Virginia, none other than Mr. Jared Woodard, formerly of Condor Options and many other myriad volatility ventures, and now the research major domo over there at BGC Partners. Jared, welcome back to the show, sir.
Thanks. I'm really glad to be with you.
And we will be joined in progress by one greasy meatball, Sebastian, running a little late as always, but we don't have time to wait for him, listeners. Oh no, because it's time to dive right on into our volatility review segment.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, listeners, this is, of course, the portion of the show where we break down the week that was from a volatility perspective. Perhaps not quite as tumultuous of a week as we had last show. Last week really was a crazy, I should say, really the week before last was crazy from a volatility perspective. This week, we had some activity, to be certain, but surely not as crazy as the week before. People were throwing all kinds of superlatives around for that week. Craziest week ever, most active options day ever, most active VIX day ever, what have you. A lot of crazy names, a lot of crazy titles and superlatives being thrown around. A little bit less so this week, but we still had a decent range. We started off the week on the higher end of the range, about 13.62 or so, a little bit north of 13.5, and then drifted down throughout most of the week, hit a low, a nadir there around Wednesday, right around 11.5, 11.41 to be precise, and have kind of vacillated around that range ever since. As we are recording this today, listeners, Friday, July 25th, we are a little bit north of that low point there, about 12.3 or so in the early part of the session. So, Mr. Woodard, as we are wont to do here on the old program, walk us through what caught your eye, what interested you in the week that was from a volatility perspective.
One of the themes that we've been talking about the last several months, I guess, is the kind of churn and just sort of range bound to lower action and vol that we've seen this year. how frustrating that probably is for short sellers in equities or for volatility longs in the options market. And I was just looking at what's happened over the last month. And in VIX, we're about a full point higher than where we started in July, even though the range this month has been, I don't know, say 5 points. So despite all the action, the big spike that you just mentioned, we don't have a lot to show for the month, even though it does look like we're at that kind of floor for volatility that we've spoken about in the past, where we may just see kind of churn at these levels or possibly a gradual drift higher.
Yeah, I believe we have a listener question a little later addressing that floor and how it may impact some of your trading styles and your trading strategies. But you're right. You're looking back on the chart of VIX over the past few months, and indeed for the better part of 2014, you're right. We have had a decent range, but for the most part, over the last few months, we're really kind of just spinning our wheels here. We had that big spike last week, which was, of course, on the 17th when VIX really gapped up, got into the 15 handle for the first time in quite some time. And aside from that, we've really been vacillating around these levels, and we dance with this floor. We've seen this play before. We dance with these levels, and then we bounce back up, and then we flirt with them again, and then the media says everything's overblown, everything's oversold, the market's too complacent, and then we get a little bit of a pop. Certainly not the mean reversion all these crazy call buyers have been talking about. Speaking of which, on a complete tangent, Jared, but speaking of crazy call buyers, I don't know if you watch individual equity options a lot, but did you see the amazing preponderance of out-of-the-money call buyers we saw going into Amazon earnings yesterday, and how completely annihilated they have been since?
Yeah, I did read about that. I watched some of those go up. And what can you say? Sometimes it doesn't work out for you. But it was pretty interesting to watch that happen.
It was, we see those a lot in a lot of different names. It reminded me a lot of back in the days of the height of Apple, when people couldn't get enough upside. All of a sudden they're piling into 100 handle and north. Not even 1 month out. These were weekly, aka daily options at that point that they were piling into 100 handles away from the money. I just craziness. I'm going to go out on a limb and just assume, for the benefit of the doubt, that a lot of those were hedges against shorts and some other type of hedging type strategy, because if those were naked outright, that's a painful day for a lot of people. Amazon, of course, trading today, listeners, down 35 handles to 323, so nowhere near the 400, let alone the 450 or beyond range as some people were anticipating. Not a volatility story so much, unless you count it as just really overpaying for a lot of one day. You can't even call it vol at that point. It's just pure gamma and nonsense at that point. But still.
Well, you could put some context on that makes it look less. If it was just sort of naked call buying, I don't know. You could put that in a context that makes it look a little bit less weird, given the kind of surprises we've seen this quarter for second quarter earnings that are being reported. There's more surprises, both in terms of number of companies and dollar value of the surprise in S&P 500 members than I think we've seen so far, more than any of the last 8 quarters. So it has been a quarter that a lot of people were looking for downside and or just for kind of more of the same. And instead you see company after company across all sectors coming in, better than expected to an extent that we haven't seen in quite some time. So you can get a sense that maybe there's a little bit of a fever burning where people feel like they really need to get out ahead of earnings, and maybe we saw that in Amazon.
Speaking of earnings and bringing it back to a volatility focus and indeed a research focus, one thing I'm constantly amazed at, given how important it is and how discussed it is, how little research there actually is on this, is exactly what you were just talking about. The number of S&P 500 names reporting in a quarter, and just even a simple rudimentary study of how many of them outperformed their front month or weekly at the money straddle. That sort of analysis I would love to see on a regular basis. I know Goldman has done a few of those in the past, some straddle studies, but they seem to be few and far between. Certainly far fewer and far less than are merited given the amount of interest in this type of activity. Is that something you guys are maybe thinking about embarking on over there at BGC? I know I personally would love to see it. You'd have an audience of at least one.
Well, we definitely the desk puts out during earnings season on a basically daily basis notes about who's reporting and what's coming and what's implied in the market versus what's been happening over the last several quarters, to get a sense of where the market is pricing the report. In terms of broader, historical research, it's tricky because there's a couple different moving parts to that whole question. There's the first, trying to predict who's gonna how a company's gonna report and what their earnings are gonna be. There's a whole industry devoted to that basically, and that's challenging enough. But even if you do get the report right, you predict revenues, you predict guidance, there's still no guarantee that the market's going to move in the direction that the report might seem to indicate. And I have seen numbers on that are a little bit surprising, that just even if you can call the earnings report right, the next day the stock might still not be where you expect it to be. And that makes the further question of, historical studies of straddles, I think, even more difficult. I mean, even if you get the earnings report right, even if you get the market direction right, the volatility response is a further variable. And I guess because of the complexity there, that might be why there just isn't a lot, as you say, of really in-depth research on that. It's a tricky subject.
Yeah, you're right. There are a lot of moving parts to that equation. Of course, if you're very active, you can dynamically hedge, and even if a straddle underperforms from a pure movement perspective, you could still make your money back if there's enough vol in between there, enough back and forth to scalp your gamma and dynamically hedge aggressively. So there are ways you could do it. But still, I think it'd be interesting at the end of the quarter, someone put out a report to saying, hey, here's the S&P 500, here's where they reported, here's what their straddle went out at, and here's how much they moved after the fact. Pretty straightforward, not even getting into all the other rubrics and variables that could really gum up the works with dynamic hedging, all these things like that. Just a straight up delta analysis, essentially. If you bought this straddle, here it is. Here's how much it moved. Here's how much it went on the open. Maybe you can add some other elements if you want. Maybe how much it moved after the open, that sort of thing. But in general, just looking back at that, I think that would be fascinating in and of itself. I know a lot of people would probably devour that type of research.
Yeah, I think you're right about that for sure.
All right. Speaking of devouring all sorts of things, I'm kind of hungry. You can tell it's lunchtime, and we are joined by the greasy meatball himself, Mr. Mark Sebastian. Mark, welcome back to the program, sir.
Hey, good to be here, guys. Sorry for the slight delay. Had a little bit of an interesting problem, but things are good now.
We are in the midst of our volatility review segment. We are just debating the merits of studies on straddles, coming back and looking at earnings quarters and how many S&P 500 names have outperformed their straddles, and the paucity of research in that. But before we even get into that with you, why don't you give us your look back on the week that was from a vol perspective of what caught your eye, as well as what developments might have interested you out in the VIX futures term structure?
Well, couple of things. Things have been, after that little vol short squeeze we had last Thursday, they're really not letting things go all the way back down to the 10 level. I thought we were going to get potentially into the single digits, and they don't appear to be letting that happen. World events, despite the fact Ukraine kind of seems like it doesn't matter, people are not ignoring that, and the stuff in Israel with Hamas and everything is really driving stuff. VIX term structure, the VIX futures has been pretty stable. It hit, after it popped from 1260 to 13, it stayed in a range between like 1290 and 1330 for the last week. That's why kind of the ETNs haven't done anything. If anything, they're up, is because really the VIX futures have kind of crept up all week, and it's really what you're seeing. So the term structure is definitely flattened up a little bit, with the front not nearly as steep as it was leading into that squeeze last week.
Yeah, I suppose that's to be expected when you have such a crazy gap up, and that you're going to see that near end of the curve get a little wacky.
Yeah, it was really unique. That squeeze last Thursday, it was one of those weird ones where really volatility, S&P options, and VIX was driving the market sell-off, not the other way around. And that's a rarity. And I think we've seen that, you might have a little higher VIX in the very near future, but it does not lead to any kind of a long-term, when you get one of these squeezes with vol leading, you're not going to, so far out of the two that we've had, we have not gone to 20 shortly thereafter, or 25.
Well, speaking of VIX options, let's take a look at some of the most active, the hot strikes that are lighting up the tape since the last time we all gathered here together on the show, and perhaps reflective of what you were just talking about there, Mark, that activity in the near end of the curve. We've seen some August strikes usurping the top spot, taking away some of the Sep, I believe it was Sep-19s last week that held the top spot. They're still up there, number 3, but the number 1 spot this week, 250,000 contracts open, nearly 245 to be precise, are the VIX Aug-14s, then followed quickly on their heels by the VIX Aug-16s. Again, pretty much call heavy as usual. Actually, entirely calls this week, listeners. So no puts to be found anywhere on the top 10 here. So 245, 241,000 respectively of those. Then the Sep-19s coming in a hair shy of that, 238,000. Sep-21s, 220,000. And then running on down the list, Aug-14s, Aug-20s, and Sep-16s, about 200,000 or so each of those as well. So size, volume on all these strikes still, and all the way down, even in the top 10, you're getting down, the lowest number is still 170,000 open. So a lot of paper lighting up the old tape here in VIX land. And for those of you playing the home game who like to watch indicators like this, call the put is just off the charts. It's way beyond even the historic levels of 3.4 that it hit. It's now way up at 3.8. So not surprisingly, given these open interest numbers, these activity numbers, the trades we've been seeing going up out there lately, that the call to put ratio is just insanity at this point. Way off the charts. Before we move on from the VIX options and just options in general, Mark, do you have any thoughts on that? What we were talking about earlier, the relative paucity of research into something even as simple as how many S&P 500 names outperformed their straddles during the earnings quarter. Is that something you'd like to see maybe a little more of?
Goldman's done a couple of studies.
That's the only ones I know of. They've done like 2 or 3 of them. That's about it.
And they consistently say that, believe it or not, the net is it's not a great idea to be short straddles or strangles the week before earnings. Now, they don't look like the day before. I don't know that there's anybody that has actually done like right before earnings, here's what the straddle was, and then a day later at that time, how much had things moved. I don't know that there's any studies like that. If there aren't, I know a guy with a PhD that would be perfect for that study that just loves having ginormous, thankless research jobs dropped on his lap. And I just happen to be on a Skype call with him right now.
You're right. For the amount of importance and weight that this material gets, as opposed to some of the other more esoteric research that gets out there all the time, this is pretty straightforward stuff that a lot of people could benefit from. And you're right. The only ones I really know of are the Goldman studies, and there's a handful of those. And that's really about it. There might be some one-offs here or there with these handful of names did X, but nothing that covers a broad swath of, forget the S&P 500, maybe even the 100, the OEX.
Yeah, I mean, that would be, I think that would be a really valuable study, or the NASDAQ 100 would be an interesting study. I know we talked about this on Option Block, but one of the things in this low vol environment that's been interesting is that weekly straddles have been really underpriced. And I don't know if Jared's been seeing this, but this will be, I believe, out of the last 12 weeks, 11 times if you bought the straddle near the close on Monday of that week, by that Friday, you at some point in time, your straddle was up somewhere between 30 and 40%. It's been kind of shocking that they've allowed these straddles to stay this inexpensive in that front month. I do think that's part of the reason why we're seeing all this weird weekly flow, and they stopped really allowing the weekly front end to be priced in a steep contango to kind of the monthlies and the balance of the curve.
You talking about straight up SPX weeklies? Or?
SPX and SPY have been they're not letting that kind of front month stay quite as low as maybe they have in the past, and for good reason. It's still underpriced. So,
Jared, has that come across your research desk as well?
Yeah, I mean, looking at the weekly flow, I think that's right. I don't have any kind of additional theory on that, but I think, like we were saying before, there's so much enthusiasm into earnings for some of these companies as the surprise rate creeps up that people may just be keeping a focus on individual names and letting the indexes be for a hedge, and whatever the reason is, it is unusual, and we see like this weekly volume keep going up quarter after quarter, year after year. It seems like something that people are paying more and more attention to. And, sometimes that makes the volatility dynamics a little bit unstable when you look at things year over year from a research perspective. The volatility in a product this year, even though you can have a time series of what's going on, if the market's changing, if the market participants are changing, then it's not an exact apples to apples comparison.
This is the part of the show where we usually dive into some of the other VIX-related products, including our VX ST. We've been watching that for a while, kind of hoping it would take off. And in the last few weeks, we have seen some decent changes, some decent growth in open interest. No surprise given the actual movement we've been seeing out there in VIX land that a short duration near-term product like that would finally catch some wind. And I know, Mark, you've been seeing some trades out there that have been catching your eye.
Yeah, yesterday in VXST, yeah, you're right. It has like these moments of being pretty active. We saw some guy they were buying a bunch of upside in the stuff that expires next Friday. And then actually the furthest dated one, which is about a month, some guy stepped in and bought the 16 calls in size, about 3,000 or 4,000, which is pretty big for that product. And, despite the fact that maybe it hasn't completely taken off, of the other VIX products, this one actually does see some action. And so if you're not watching it, this is one that should be on your kind of tab of underlyings you watch, because there is some open interest. The stuff that expiring today, open interest there's almost none in the puts. It's spectacular. But there's open interest in the thousands in multiple of the months. The big trade was that this guy buying on the August, the one with 18, I want to say the one next week, he bought a bunch of upside. So it's been kind of nuts, all the paper flow that we've seen. And that's a product that I think eventually will find a home in investors' hearts.
This is one, like I said, we've watched for quite a while and for a long time after launch. I mean, it had a lot of fanfare leading up to launch. For the months leading up to it, everyone kept asking, when's the VXST launching? When's it launching? It finally launched, and it kind of just whimpered out of the gate. It struggled to get 500 ADV on any given day. Open interest hovered around 1,000, maybe 1,500 if you were lucky. And then over the past month, that's really changed. We've seen, as we're talking right now, as we're recording this today, listeners, open interest stands at 4,300, which is pretty sizable out there. It's well above even the spiking average it's had of late, about 3,300, so about 1,000 beyond that. So you're right, a lot of paper, and including a lot of upside. July 20s expiring today, the weeklies, 1,000 of those open, 1,100 of the July 17s expiring today as well. So a lot of upside paper. And you're right, as call heavy as VIX, the mothership, is, this thing is just nothing but
all
calls. There's I think a 10 lot of puts open somewhere, and that's it.
Yeah, well, I think when one of the problems with this index is going to be a lot if we see the VIX was the timing, right? If we see the VIX get up like 17 or 18 or 19, let's say a more normal range, let's say even 15 or 16, I think you'll see some two-way action on that as you get guys willing to maybe play a little contango, guys willing to play a little, play for upside, because in an environment where vol's a little higher, this is going to have a nasty, nasty decay to it.
Mr. Jared, do you watch the VXST? I'd imagine it has to be growing. You track a lot of products over there. It has to be growing on your radar, given just the open interest we're seeing increasing out there.
I do try to keep an eye on it. It's in the list, like Mark mentioned, that list of things that you keep one eye on while you're doing other things. I think that you guys are right that as soon as the volatility regime changes into whatever it's going to be next, that VXST is probably going to become popular fairly quickly. You saw this with the VXX ETN in the kind of the last big market cycle as volatility increased, and then anytime there's any kind of risk scenario coming on, people really pile into those products. So I think that VXST and the kind of any new crop of volatility stuff is really just going to do better when the market isn't as deathly boring as it has been lately.
Well, speaking of markets that haven't been boring, we also talk a lot here about RVX. We've had a lot of folks from Russell here on the program, and they were talking to Bloomberg this past week. So Bloomberg even diving into the RVX wheelhouse this past week. And RVX has been having some developments of late. It's been moving quite a bit. In fact, last week it reached its highest level since 2006 in comparison to the VIX. Now, obviously, it hasn't been listed that long, listeners, only since the beginning of this year. So that's all historical data, but still, the divergence there is pretty impressive. And yet, for whatever reason, we haven't seen a correlating story like we've seen in VXST with a corresponding uptick in open interest. We've talked on the show in the past. We've seen a couple of thousand open, even up to, I think, a few thousand more at one point there in RVX. But of late, a lot of that has expired. And new positioning, for whatever reason, even given this divergence, hasn't really come to pass yet. We see about 500 contracts open out there in RVX as we speak. Actually, I'll take that back, though, today, because we do see, surprisingly, we talk about everything being put heavy, and it looks like 100 lot of puts just went up today. So there we go. That'll bump it up to about 600 open interest. But does that surprise you at all, Mark, that we're seeing this divergence between the two indexes, and yet, for whatever reason, not a heck of a lot lighting up the tape out there from an options perspective?
Yeah, I think a lot of people, you got to look at, the user. That's actually the problem is, there's not a big variance trade that trades up on the Russell 2000. And without that, that's going to cause the product to be a little slower. You need a little more liquidity in the future as well. So the combo of those two. Now, as we do some studies out and managers start looking at the Russell 2000 as something that maybe you buy right, or you do some the Russell buy right index, which I think they're going to come out with if they don't have it already, will stuff like that will hopefully help drive some traffic in that product.
Yeah, and I would say too that this dynamic between the RVX and VIX this year, I think to trade on that, it's good to have a view on what's going on in the underlying indexes. Small caps have lagged, the S&P so dramatically this year. Not just over the last month, which has been pretty notable, but really since that big sell-off in March and April, where both the Nasdaq and the Russell took it on the chin compared to the S&P, and ever since then, Russell's been kind of lagging. And I think that there's probably some people with an economic thesis about what's happening there that is driving the returns in Russell. And as long as that lag is in place, then I think we may see RVX and VIX kind of diverging from one another. So maybe a little underlying economic thesis is probably helpful to have if you're going to trade that pair.
That's what surprised me, because the last time we saw those divergences emerge between those two products is when we saw some pretty sizable open interest coming into RVX, several thousand contracts at least. Yet this time, for whatever reason, even though it's larger and it's focused on the volatility end of the spectrum this time, as opposed to just, let's say, S&P 500 versus the Russell 2000, then it's not attracting the same level of interest for whatever reason. So interesting stuff. We're going to keep an eye on it, as of course we do every week here on the show, and see what can goose up some volume out there in RVX land. Meanwhile, we're going to move on to some other asset classes we like to touch on. We know a lot of you out there trade other products in addition to index and equity volatility. So we're here for you as well, listeners. And we've been checking in a lot on some of the other products in the commodity space the last few weeks. We've seen some decent developments from a vol perspective out there in the energy spectrum, of course, spiking off of the news coming out of the Middle East and the resulting turmoil over there. Brent has come off since that time as well. Seemed like a near-term spike, a near-term bump, and then the sell-off commenced once everyone realized that the sky was not falling, and that seems to be pretty much the pattern again this week. Crude was relatively stable. A lot of the opening positioning, opening sentiment coming in places like ICE and into products like WTI seems to be on the bearish side of the tip these days. So it seems like we're in for a relatively steady volatility return to normal if we haven't already seen most of that playing out in the marketplace already. Is that pretty much your take as well there, Mr. Jared?
Yeah, I think there's two things you could point to that would should be convincing that crude has kind of returned back to normal conditions. If you look at the skew curve in say like 1 month options today compared to 1 month ago. A month ago you had significant curve upside in out of the money calls, where people were bidding up those out of the money calls, presumably on the political and event kind of risks. And today that's flattened back down towards a more normal shape. And the same thing in the term structure. While the term structure of implied vol didn't really backwardate that much in, for example, USO options or crude oil futures options, the overall curve has just generally drifted lower across the board compared with 1 or 6 months ago. And so everything looks kind of like it's back to normal. The spread between implied and realized volatility is back down as well from higher levels about a month ago. So everything looks like it's sort of back to normal trading, even though some of the political conditions that generated, I think, the bid in implied vol still kind of persist.
Yeah, I'm looking here, and a lot of our listeners like to play in the ETFs as well, including USO, despite our comments about it in the past. And even here in USO, the open interest is off what is traditionally about 100,000 contracts off of even its average levels out there in USO. So clearly the interest out there waning, at least in the near term, from a vol and from an options perspective, and as anything potentially happening out there in crude. And I'm kind of with you, Jared. I'm a little bit surprised as well because the fundamental underlying scenario hasn't really changed. And yet we had this big spike, kind of like we saw in VIX, and then coming off after the furor subsided. Similar scenario out here in gold. Mark, you guys looking at USO or talking about crude over there in the pit chat at all?
We looked at that a little bit, and it's fine. But the problem with crude is that it's so crude volatility is weird because it just doesn't react the way you expect sometimes. It's definitely, I think, less predictable than S&P because it'll blow up on a rally, then blow up on the way down, or it'll tank on a rally and then tank on the way down. And we saw a huge pop in crude vol, the OVX, and then it's just been kind of down since then. Even with ever since that flight went down, we got a big pop then, and then it eased off again from there. So yeah, nothing really exciting to trade there.
I think you can play a similar story out in the metals as well. Last week, of course, there was a lot of activity going on out there, a lot of vol movement out there in the shiny stuff, gold and silver in particular. And this week, not so much. The products selling off a bit, coming off a little bit off their floors, but nothing really too aggressive to look at. IV out there in GLD and SLV hovering maybe a little bit higher than normal range, but nothing too elevated looking at across the board. So nothing really too aggressive out there from a vol perspective going on in precious metals land. Copper also dropping a little bit on the news recently as well. So anything catching your eye from a vol perspective out there in the shiny stuff, Jared?
Just that it seems like maybe there's a bit of a floor kind of forming in place. I don't know if it's here yet, but this is a thesis I've been kind of gradually thinking into my way into over the last few months, that at some point we're going to see, just like we talk about sometimes that natural floor in VIX, I think there's a level in commodities or in rates or currencies where people just aren't going to sell premium any cheaper. And maybe that we're approaching that point in some of the kind of macro sensitive products. Metal has been, GLD options you mentioned have been bid up lately, kind of haven't gone lower than 12% for like a 3-month option this year. And it may be that they're going to sort of be flat to higher from here as the overall kind of rates and policy picture around the world starts to gradually change.
Yeah, you're right. The norm out there is about a 12%. They're hovering around a 13 to 14%, depending on the month you're looking at out there in GLD, SLV, in the 20 to 21%. A little bit more volatile out there, but those aren't erratically far off the normal levels we've been seeing out there of late. Mark, anything catching your eye out there in the metals lands of late?
Not really. We had that nice pop with that sell-off, and then it's just been kind of smooth sailing since then. So nothing real special.
All right, then we'll close out this segment of the volatility review, as we always do, by looking at the international volatility spectrum. And Jared, I know you watch a myriad of international volatility markets through your volatility tracker. So tell us what caught your eye over this past week from an international vol perspective.
A myriad.
Yes. Veritable plethora, if you will.
A cornucopia of indicators. And the big two changes I would mention. First, over the summer, there's been a big gap between implied and realized vol in a lot of different world equity indexes. We call it the volatility risk premium sometimes, and that's been a big gap, and it's been in place just because realized vol was so low. Implied vol wasn't going to go any lower, and so you had that kind of persisting week after week. And with that pop we talked about last week, this sell-off, mild as it was, it generated enough volatility in terms of standard deviation to get those estimates back up to a level where in most countries around the world now, that vol risk premium is much more moderate compared to the last several years of data. So that kind of relieved those extreme conditions. Two exceptions to that I would mention are Australia, where you still have relatively low rank in terms of overall vol risk premium, and then Japan is the other extreme at the other end, where there's still actually quite a large gap between implied and realized vol. People are still nervous about Japan. They're driving a bit of a premium in the options there, but you're just not getting the kind of reaction, at least in equities, that would justify it for now.
Good stuff. And Jared, if listeners want to check out more about your volatility tracker, is that exclusively for BGC subscribers now?
That's right.
Well, there you go, listeners. Just become a BGC subscriber, and you'll have all the access you want to Jared's very, very interesting volatility tracker and the other products he's cooking up over there. And, of course, I mentioned we're going to have a little bit shorter show today, listeners, because I have to hop on a plane, but that doesn't mean you're not going to have a chance to join us on the program. So let's dive right on into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail. This is, of course, the portion where you guys get to share your questions, comments, and insights and make your voices known here on the old Vol Views panel. Like the man said, no shortage of ways to make your voices heard, just like our first listener did via the mobile app here. This comes from Nick Snow. This name looks familiar. I believe he's written in before, been listening for a while. He writes, I figured this would be a good place, or at least the right place, for this question. What is implied vol? I mean to ask, for a stock, we just get one number, but every strike has a different implied volatility. So when we get one, is that the average of the smile, or is it the at-the-money straddle vol? Seems like I should know this if I am trading it. Sincerely yours, Nick Snow. Well, Nick, yes, you should know this if you're trading. It's a good question to ask. And you're right, it can be a little bit confusing because, stocks and those type of Delta One products, a little bit different game out there. There's one real spot price that everyone's fixated on, whereas in the realm of options, you're right, there's a legion of strikes to look at, and they all have their own volatility levels. But when you're generally seeing vols quoted, like I was just talking to Jared about the volatility levels we were seeing out there in GLD in the different months and SLV, I just quoted one number. And what that was essentially the at-the-money straddle vol. That's pretty much the ubiquitous shorthand for the vol of a product. So when everyone quotes, the vol in SPX this month is whatever, or the vol in GLD is whatever, or whatever the case may be, 99.9% of the time, they're quoting the at-the-money straddle. They're not giving you some sort of weird amalgamation of all the entire skew or anything like that. I mean, if you ask about a particular strike, they'll give you the vol for that strike. But if you're asking just general vol, what's the vol in here? That's the at-the-money straddle. That's why people like to do straddle runs out there. That's why those are so important for years. People say, hey, give me a straddle run this product. What that does is just give you straight across the at-the-money vol in all the different expiration months, and that's what helps you construct the term structure that we're always talking about here in products like VIX and everything else. So yeah, when people mention vol to you or you're seeing a vol quote from something, it's going to be the at-the-money straddle. Anything to add, Jared or Mark?
Just that, for any VIX type product, I mean, it's either at the money usually or that VIX methodology, which is just a way of calculating vols that you could apply to any security or product with options. And so that methodology has become extremely popular. And so usually it's either one of the two, either at the money or VIX methodology, which does incorporate obviously skew and multiple months.
Yeah, VIX, you're right. VIX is a little bit of an aberration. It's an amalgamation of a couple months and some skew in there as well. So it's an interesting idea. But yeah, most times you see just a regular non-VIX related product is typically going to be that straddle. Great question there, Mr. Snow. Good luck in all of your trading. All right, next up we have a question from a listener. I'm not sure if it's his name or if it's his handle. Mr. Higgins. He writes, Dear Volatility viewers, the Proshares Ultrashort VIX, ticker symbol UVXY, hit a low in June. I thought the spread between VIX Cash and UVXY would continue to expand, but UVXY seems to have leveled out. What is your analysis of the trading relationship between these two products? Are they reliable spreading candidates? I'm not much for futures, so I'd probably stick with straddles in each to capture the divergence. Thanks for the program. Please give my regards to Don. Well, I will pass those along for you there, Mr. Higgins. I know Don listens to the program on a regular basis and writes in with his questions and comments for us on a regular basis as well, so I'm sure he'll be happy to hear your thanks. I know, Mark, you guys over there at the pit love to watch all of these various VIX ETNs. You talk about them in your pit chat a lot. Are you a big fan of UVXY? And then also, what's your take here on his question about the spreading relationship between UVXY and the old VIX flagship?
I don't know that being short UVXY can be very nice, but that thing can blow up on you. Um, Using VIX to hedge a UVXY position can be complicated. There's some really cool different things. I actually think you're better off spreading between the ETNs than spreading between, UVXY and VIX futures or things along those lines. So, but it's absolutely doable.
All right. And speaking of doable, we can get on to our last question here. This comes from Neil Thurston, writing out of near my old stomping grounds, Danbury, Connecticut. He writes, Iron condors in the VIX. Uh-oh, iron condors. This is up your alley here, Jared. Put your listening ears on. He writes, I've become enamored with iron condors, both long and short. I'm trying to line up 2 to 3 month short at the money iron condors using VIX options. As you pointed out multiple times, the VIX is very call heavy. The calls are very pricey compared to puts. When shorting an at the money iron condor in VIX, I clearly have to purchase the higher strikes to protect against the world exploding against me. Call me crazy, but I think I'm going to leave the lower strikes open. Do you think this is a little bit of a typo here, overly risky, I'm assuming he means to say? It just seems like a waste of premium to hedge against a VIX move from 11 to 9. Well, interesting question there, Neil. We talk a lot about those types of strategies out here, and he seems to be asking, essentially, he wants to come out short some at-the-money vol out there in VIX, and as you are wont to do in an iron condor, you buy those wings to protect it. In this case, he's saying he's not too concerned about that downside risk out there in iron condors and VIX. Jared, you spent many years, you were one of the earliest proponents I saw of iron condors before they became the fad that they are today. So you spent a lot of time trading these. What's your take here from Mr. Thurston? Is he right? Is it a waste of premium to hedge away the downside? Should he be doing these essentially broken wing iron condors?
Yeah, like as an iron condors hipster, you mean?
Yes.
I liked them before they were cool.
You are very much an iron condor hipster, definitely. You have the big, thick, wire rim glasses and all that stuff.
I mean, I can totally understand the intuition in the question there. It makes a lot of sense. I mean, you're not going to be too worried about a VIX of 8 or whatever. So I can understand where that comes from, but I'm not going to give any advice. But I could say on the other side of that, I think the real question to think about isn't about what kind of move in VIX are you concerned about, but actually whether the market for, call them VIX 9 or VIX 10 struck options is right or wrong about where those contracts are priced. If they're priced low enough, then that protection can actually make quite a lot of sense. I mean, think about it this way. Let's say that the market dips a bit and there's some bad economic data for a couple weeks and then starts to rally really quickly again. You can imagine a scenario where the market rallies so fast to the upside that you do get a bigger than expected decline in implied vol. And if your iron condor is like 1 or 2 months out, pretty short time frame, it's not inconceivable where there's a scenario where the market's rallying so quickly, implied vol selling off so quickly that those short puts come under pressure. That's got to be the worst feeling in the world if you have that kind of position on. So I think that it may not be a total waste of capital to be hedging those downside puts. Another thing to think about, depending on what kind of account you're using, is whether being short the put naked is going to be effective for you in terms of margin requirements.
Yes, a good thought as well. People often don't think of the margin aspect when they do these trades. Are you still slinging a lot of iron condors these days, Jared, or is all the research taking up all your time?
I don't get to trade, much, unfortunately, but I definitely keep a close eye on what's going on in terms of pricing with respect to condors, and so that's definitely something always on my radar.
All right, everybody, great questions as always. Keep them coming. We love to hear from you guys. Meanwhile, we're going to keep on rolling right on into our final segment. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, gentlemen, this is, of course, the final portion of the show where we look ahead to see what the vol gods have in store for us. The clock is ticking, so I will toss to you first, Mr. Sebastian. What are you looking for the week to come in VIX and any other vol products you want to dive into?
I don't know. I just think that it's probably likely to head back toward 11. I just don't see a lot of things that are going to really drive us that much higher. And I would probably lean short here. But then again, often my outlook is my position. So take that for what it is.
Are you talking up your position again, sir? Shame, shame. For shame, sir. At least I know Jared, he has no iron condors on anymore, so he can't talk up his position. So, Jared, what are you watching for the week to come?
I'll speak for myself and probably Andrew if he was on today too, and just say, more of the same. That's my Andrew impression.
That's a good impression.
I had a flashback for a second there. I thought I was talking to someone from Maine.
Yeah, I mean, you can't look. I'll tell you this though. There's a lot of data coming out next week, and it's kind of the market moving potentially sort FOMC, the next GDP release. What else? Housing data. I think there's one or two other major kind of events, and so any of those could be potential catalysts if people decide to make them such. The term structure in S&P options is pretty steep historically, so that's one thing that we've been looking at is taking advantage of that. And I think that the costs of hedging now are so low relative to where they can be historically that I wouldn't have something on perpetually or constantly. That gets expensive. But if there are particular data releases that you're thinking about that may move the markets, it's not a terrible time to put something on.
Wise words, sir. And unfortunately, we have to leave it there because that's all the time we have for the Crystal Ball segment. It's also all the time we have for this episode of Volatility Views. But really quickly, let's check in with each of my cohorts here on the old Vol Views panel, see what they have cooking that may interest you. Starting off with you, Mr. Sebastian, what's coming down the pike over there in the land of Option Pit?
The Option Pit Boot Camp is, of course, coming soon. It starts the August the 13th. It's $147. But as you know, if you are a client, if you are a listener to the Options Insider Radio Network, use code INSIDER to take 20% off. So, it's already cheap. Now I'm making it cheaper. So go ahead and use it.
It's a veritable Black Friday in July over there at Option Pit, listeners.
It's Christmas in July, literally.
Black Friday is like Christmas for the shopping folks out there. So there you go, listeners. All the sales you can possibly get. Surf on over to optionpit.com. Tell them I sent you, and they'll slam the door on you. But still, they'll let you they'll let you pay first before they slam.
There you go.
All right, Mr. Woodard, what's cooking up over there at BGC Partners?
We talked about the VIX put-call ratio or call-put ratio. It is fairly frequently, and I'd looked at this in the past, but hadn't done an update in a while. So just kind of did an update on that ratio and looked at whether it had any predictive value, and just came out yesterday in our weekly note, and the results were a little bit surprising to me, and I suspect most people who watch the indicator. So that's something to keep in mind. And,
you're going to leave us hanging? You're not going to give us any insight into the results at all? Oh,
no,
you're killing
I'm just going to leave it at that.
Killing me. Well, tell you what, how about this? I know Mark and I are both interested. So if we round up, let's say $5 each, can we get that straddle research for, let's say, last quarter? And that's $10. That's worth it, right?
Yeah, right. And also coming up, I guess I've been given the assignment to do this gigantic straddle project.
Yes.
So look for that
That's
sometime next year.
Awesome. Can't wait.
All right, good stuff. Good stuff as always. And on behalf of Jared and Mark and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, making it such a success. See, I told you, short show. We pretty much got a full-length show anyway, listeners, and nothing to complain about. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. Or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.